Hello, my name's Faith, and today we're going to be talking about decumulation. Decumulation is about changing gears from saving to spending. For some people, building up a pension pot is the easy part. In retirement, their challenge lies in moving from saving to spending. Spend too much and you risk running out of money, but spend too little and your retirement may be less enjoyable. So where do you start? First, you need to determine how much you've saved towards retirement. This involves totalling up workplace and private pensions, state pension, cash savings, ISAs, and any other investments. The earlier you start retirement, the longer you might need your money to last. You'll be able to access your workplace and private pensions from the age of 55, rising to 57 from 2028. And if you're eligible, you'll be able to claim your state pension from the age of 66, rising to 67 from 2028. It's hard planning decumulation when you can only guess how long your pension money needs to last. Luckily, the Office for National Statistics, the ONS, has a life expectancy calculator. Just pop in your age and your gender, and it'll let you know your average life expectancy. A good rule of thumb is to aim for a retirement income that's 2/3 of your current salary. So if you currently earn £30,000 a year, you might want to aim for a retirement income of £20,000 a year. But if you're freelance or self-employed, that may be harder to calculate. Fortunately, the Pensions and Lifetime Savings Association, the PLSA, has created a set of retirement living standards to help. Go to retirementlivingstandards.org.uk to find out what a minimum, moderate and comfortable retirement might look like. Whatever income you'd like to live on in retirement, the reality is driven by how much money you've saved. Luckily, you can use the PensionBee pension calculator to help. Using the calculator, put in your current pension pot totals and contribution amounts. You can then see what income you can expect at different retirement ages. There are different options for taking money out of your defined contribution pensions. First, you could delay taking your pension pot and leave it invested. Alternatively, you could withdraw the whole lot, of which 25% is tax-free. Thirdly, you could use the money to buy an annuity. An annuity pays a guaranteed income for as long as you live or for a fixed term. You also have the option of taking 25% of your pension pot tax-free prior to purchasing the annuity. Fourth, you could leave the money invested and take a flexible income via pension drawdown. This also gives you the option of taking 25% of your pension pot tax-free. Fifth, you could leave the money invested and take it as a number of lump sums. 25% of each withdrawal will be tax-free and the rest is taxable. Or you could use a mix of the above. Clacks on alert. Withdrawing money from a pension isn't the same as taking cash out of a savings account. Only 25% of a pension can be withdrawn tax-free. The rest gets taxed as income. If you have any money left in your pension pot when you die, it won't be subject to inheritance tax. But if you're 75 or older when you die, your beneficiaries will have to pay income tax. If you withdraw anything more than the 25% tax-free amount, you'll only be able to contribute a set amount each year, which is typically much lower than the annual allowance. This is known as the money purchase annual allowance, which limits how much you can put into a pension once you've started taking money out. As part of your retirement plan, you'll need to consider things that are out of your control. Inflation can erode the purchasing power of our retirement income. You'll need to plan for rising expenses in the years ahead. You can use PensionBee's inflation calculator to see how your pension might be affected by inflation. Your spending patterns may fluctuate during retirement, from indulging in hobbies and holidays to potential healthcare expenses. Using drawdown to fund retirement offers potential for higher growth, but it also exposes you to stock market movements and therefore risk. If you purchase an annuity, you can't change your mind later down the line. Annuity rates fluctuate, so if you've purchased an annuity with a lower rate and they increase in the future, you won't benefit from the higher rate. If you're over the age of 50 and want more guidance on your pension options, you can book a free appointment with PensionWise. Your pension provider might also have a pensions toolkit. If you want specific suggestions based on your own situation, you'll need to pay for independent financial advice.